dream. I was flying high, I was feeling fine. I won't be put in line 'cause I'm ready.
Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. Thanks for joining me today. This is episode number 12, season number 3. On today's episode of the Simply Financial podcast, I have a very special guest. I have with me today Peter Hugg. He is the Director of Global Trade for Kitco Metals. He has been involved in the precious metals industry since 1974. He is a frequent speaker at precious metals conferences and in the financial media. He speaks to thousands of viewers each week on Kitco News, drawing on his years of frontline experience to provide a trader's perspective on the market. So it's a real treat to have him on. I got a great outline. I'm really looking forward to picking his brain on a number of topics related to gold and silver. So, Peter, thank you so much for taking a few minutes out of your busy day to talk with me.
It's a pleasure to be here, Chris.
So it was kind of, at least for me, a long-winded background. Did I cover your background okay?
Yeah, you certainly did. I came out of university in '73 in Toronto, and I cut my teeth in the foreign exchange business. And about 2 or 3 years later, I was hired by a bank that wanted to engage in precious metals. And we were fortunate enough to catch the gold rush of '79-'80 and developed one of the largest trading operations for precious metals in Canada through the '80s and early '90s.
Very good. And so just to catch listeners up, your title, Director of Global Trade, you do that for a company called Kitco Metals. But could you just give a summary description on what a Director of Global Trade does or what you do as Director of Global Trade?
Well, it's, as an overview, I run the trading operations for Kitco North America as well as our office in Hong Kong. So when clients buy or sell precious metals from us, it creates a liability on Kitco's books. If a client buys metals, the company needs to cover that trade. And if clients sell us metals, we're long the metals, we need to hedge that trade as well. So my job is to maximize the profit and at the same time manage the risk of trading in precious metals and the foreign exchange that's attached to it. We have reach not only in North America, but all through Europe and the Far East. So many of our clients do not trade in dollars. They trade in euros or in pounds or in Japanese yen. So there's a foreign exchange component to our transactions as well that needs to be hedged. So that's my job primarily. And beyond that, I represent Kitco at various conferences and in views of the market, but I also develop new products for the company as I see fit.
Very good. So I was thinking that Director of Global Trade sounded awfully impressive, but it sounds like it actually doesn't sound like that. That is pretty impressive. So I wanted to ask you, I want to get your thoughts on gold in the short, medium, and long term. But first, can you give us your opinion on why investors should own gold?
Okay, so let me premise that answer by stating that, I don't believe gold is an end-all, be-all investment. I mean, gold has a place in a portfolio. Sometimes the weighting of gold in the portfolio is going to be greater. Sometimes it's going to be cut back depending on the circumstances of where we are in the economic cycles, supply-demand issues, potential geopolitical issues. So I think there is a place for precious metals in a balanced portfolio. So if your audience is looking for me to say, the world is coming to an end and gold is going to go to $10,000 an ounce, I'm just not in that camp.
Okay.
I think that there are a variety of serious risks on the horizon. One being the equity markets in the U.S., which I think are top-heavy at current levels. The issues with Brexit in Europe, the issues with some of the Italian banks, the issues with the slowdown in the European Eurozone. Mario Draghi, the president of the EU, came out this morning and basically postponed raising or tightening their credit policies at least until the end of 2019. They're concerned about growth. There's issues with China and the U.S. with the trade war. So there's a number of macro factors in the market that suggest that the other investments that you may have in your portfolio may be subject to increased volatility in 2019. And in that context, gold tends to be a relatively secure hedge to protect your portfolio in times of anticipated increased volatility.
Okay, so you think, and this is your opinion, and let's just acknowledge, you and I, that we're not giving individual advice. Nobody should go out and act just on anything you and I are talking about. That's crazy. But generally speaking, in a diversified investment strategy, your opinion is that there's a place for gold at all times, but that allocation may increase or decrease based on general market circumstances. Is that right?
Correct. I mean, it would be the same context if you had a balanced portfolio of stocks, bonds, for example. And again, depending on your age group, your risk tolerance, you have, the equity markets that run up 200%. It might be prudent to pare back some of that weighting in the equity side and maybe increase your bond weighting. So, it's a matter of managing your portfolio. And what people tend to do, investors tend to do, and this tends to be sort of a negative way to invest in gold, they either go to a conference or they hear somebody that indicates the world is coming to an end, and they load up on gold, and they just buy it and they forget about it. And gold, to me, is no different than Apple stock. You need to balance your portfolio on a consistent basis, minimum at least once every 6 months. So, and then you need to look at the psychology of why you're making the investment. Are you making the investment from a capital gains perspective, or are you making the investment from a perspective of an insurance policy for the balance of your portfolio? So let's assume you're making it from the perspective of an insurance policy. You want some protection against the overall volatility of the balance of your portfolio, which consists of bonds, stocks, real estate, whatever comprises your portfolio. And you go in with the mindset that you want a 10% weighting in your portfolio of gold. And that weighting could be in the form of physical gold bars, it could be in the form of ETFs, could be in the form of gold mining shares, but you want a 10% weighting. You can't just buy the 10% and then forget about it. You need to manage that in the context of your entire portfolio. So just to give you sort of a real simple mathematical type of example, let's assume you bought gold in 2008 when gold was trading at about $600 an ounce, and in 2011 gold was at $1,900 an ounce. I can almost guarantee you that your 10% weighting, if that was your psychology, was probably now worth 19 or 25% of your portfolio.
Right.
So you need to pare that back to stay within that 10% weighting. And the same holds true the other way. If you would have bought gold at $1,900 in 2011 because you believed it was going to the moon, and then in 2012 gold was sitting down closer to 1,400, and then went down all the way to about 1,060 in 2015, your weighting in gold was probably not 10%, it was probably now at 3%. So you need to add 7% to get back to 10. Now, when you do that, you then have a correlation of 10% of your portfolio in gold, but you tend to exit the market on gold strength, and you add to your position on gold weakness, with the intent of always being at a 10% weighting.
No, I think that is great. And my practice, Elliott Wealth Management Services, as a certified financial planner, Peter, is that we do rebalance, big believers in rebalancing. And you're talking about a specific allocation that should be rebalanced. I did an episode back in season number 2 of the podcast. It was episode number 5 of season 2. It was titled Portfolio Rebalancing in Today's Market. So I fundamentally agree with the idea of rebalancing, not just for gold, but you could go back, and you've been in the business a long time like I have. You could go back to similar instance at the 2000s when tech stocks ran up so strongly that if you didn't rebalance, you got really, really hurt with the tech wreck that happened in 2000, 2001. And you could take the same approach with what happened in the financial crisis when stocks ran up prior to the crisis. If you didn't do some rebalancing to other more conservative non-equity investments, you would have been harder hit in the financial crisis. So I agree completely. You mentioned a few things I was hoping we could unpack for our listeners that may not be terribly familiar with how can you invest in gold. So you described a few ways. You can do paper version, things like ETFs, like GLD, I think is the most popular symbol. That's basically gold without the O. That's the symbol. It's an ETF, and correct me if I'm wrong, Peter. That's a proxy on the price of an ounce of gold. It's a paper asset. That's one rather easy way that you could participate in gold. Here's what I'm thinking about. That's a good way to invest in gold, but you don't physically own the gold. But it does allow you to more easily own it in retirement accounts like IRAs, Roth IRAs. So is that one of the key features of investing in the ETF, the paper asset version of gold, where you don't physically own the gold, but that also allows you to own it in retirement accounts? Is that a good way to look at it?
Again, I would make the argument that you own the gold the same way you would own Apple stock. Basically, it's an ETF is backed by physical gold. At least that's what it's supposed to be. It's audited. Many people don't believe the gold backing ETFs is actually there, but that's a different mindset of investor. But buying an ETF in gold, like when you buy Apple stock, Apple stock is not issued and segregated into your account. You're holding it on a seg basis in the broker's overall portfolio of Apple stock. So an ETF in gold is similar. The ETF is backed by gold. There are charges on the ETF. They work out to about a little over 1% per annum. So it's sort of similar to a mutual fund on an MER basis, but it's relatively easy to trade it. Again, from an IRA perspective, you can hold it in your IRA in the format of an ETF, but you can also hold physical gold in an IRA. You're allowed under U.S. law to buy a 10-ounce gold bar and have it delivered to your custodian, your trustee, who then holds that 10-ounce gold bar in your IRA account for you. So you could also buy physical gold in an IRA. IRAs are not limited just to equity transactions or ETFs.
That's a good point, Peter. But is it fair to say that in that second instance, not all custodians are set up to accommodate such a position in an IRA? A lot of mainstream ones like Pershing, Fidelity, Schwab, I don't think they could do the physical gold part of the IRA. You do need a special custodian. Is that fair?
Well, I think they can do it. It's the question of whether they want to offer the service. I mean,
gotcha.
Somebody like a Gold Star tends to be one of the bigger ones in the U.S. that aggressively markets precious metals for IRA investments in the physical format. But there are a number of trust companies and trustees that offer their clients the ability of holding gold in an IRA.
All right.
Now, the other firms may not find it profitable enough to get into the physical market. They tend to be, they probably feel it makes more sense for them from a revenue perspective to offer ETFs or gold mining shares, where their commission structures are a bit more aggressive than they would be on a physical gold transaction in an IRA. But that is really the choice of the trustee. It's not a matter that they can't do it. It's a matter they choose not to do it.
So other options other than buying GLD, which is an example of a proxy for the price of gold, and we talked a little bit about the physical gold, although I have a few follow-up questions on that. You could also buy stocks of companies that are gold miners. Some of the more popular names are Barrick Gold, Newmont Mining. You probably know many more off the top of your head. But what are the pros and cons of doing that instead of GLD, kind of the more passive approach?
Well, I think there's when you're talking about gold mining shares, there is more leverage, and there's obviously, because of more leverage, more risk. So not only are you investing in the gold mining company, you're investing in basically the management of the company. You're investing in their gold reserves, their cost of production. So it takes a bit more work to come up with a valuation that is reasonable, so that you can make an investment decision to determine which of the gold mining companies offer the best risk-reward from an investment perspective. Now, most people, when they buy gold mining shares, tend to get enamored with the junior gold miners. And, really, in my opinion, on a junior gold mining basis, you may get lucky, but quite frankly, I think your odds are better at a casino than making money on juniors. Because the problem with a junior, unless they've got a good history of management and they've got some proven track record, is you've got somebody or a junior company that's come out, they've hired a geologist who always tends to be old and gruffy, and says, look, we've got, we think, gold reserves or proven gold reserves in the ground of X number of ounces or X number of grams per ton. And then they go out and they raise seed capital, and everybody gets excited. From the point of that guy telling you that they've got X number of grams per ton in the ground to it actually coming out of the ground is a huge and long process and costs a lot of money. So, these juniors tend to refinance a number of times, which creates obviously a problem for your stock positions. And what they do is sometimes they'll come to market and actually produce. So to me, it's a gamble. You're going to buy 10, 9 are probably going to go to 0, and 1 you might get a home run on. So it really is, in my opinion, I consider that more speculative than an investment. Now, if you look at the majors, like a Barrick or a Newmont, they're not necessarily great either. It really depends on where the gold price is going, their cost of production. So again, it's a company that you need to analyze their balance sheet, the same way you would analyze a balance sheet of any equity sitting in, on the exchanges. What I tend to like, if I'm getting into that type of an investment in the precious metals arena, is I like the streamers and the royalty companies. And there I like Franco-Nevada. The management there, I've actually known for almost 40 years. I mean, they're top-notch managers. And Wheaton Gold. These people own royalty rights in hundreds of mines. Okay. They have no overhead. They just get a piece of the action of everything comes out of the ground. So I think they are a better proxy for the price of gold when it moves up or down than even the seniors are in most circumstances.
All right, great. So the another option is the physical gold, and we did talk about owning the physical gold, holding it at a custodian, such that would be required for an IRA. But what about an instance where you want to own physical gold, it's not in a retirement account, and you want to physically keep the gold yourself? First off, how common is that, and how do you feel about that as part of what we talked about earlier, a diversified investment portfolio. Can you touch on that for me?
Yeah, well, you're still going to get the diversification because you're holding gold. Now, the downside of holding physical gold and not holding it from a custodial perspective somewhere is you're going to receive the gold, and it's a very common transaction. I would tend to think about 30 to 40% of the physical transactions that occur in especially in the U.S. market, are ones where the client is actually taking physical delivery of the metal to their home. And so now then you've got potentially storage issues, potentially risk issues if you get robbed. I mean, gold is not covered under your blanket insurance coverage of your home insurance. It's treated more like jewelry. You need to get a specific insurance for it in case you are worried about somebody taking your gold from you. The other downside of buying physical gold as opposed to investing in, say, an ETF, assuming you have a comfort level with an ETF, and there's a percentage of investors that just do not trust the system. They don't trust that the gold is there backing the ETF. They don't trust the miners because they've been burnt over the past 5 years with mismanagement, and they want to hold the physical gold. Now, in that context, it's going to be more expensive because holding physical gold, other than the fact of worrying about storing and insuring it and possibly paying shipping charges depending on the dealer that you engage with, is you pay what's called a premium to the gold price, which is in industry terms called a fabrication charge. And the rule of thumb is the smaller the gold bar, the more expensive the fabrication charge relative to the gold price. So to give you an example, if gold was trading, we'll just use round numbers, at $1,300 an ounce, and you bought a 1 ounce gold bar, again, depending on the dealer, you'll pay a premium of anywhere from $20 to $30 over the gold price for that 1 ounce of gold.
So is it fair to say, because I have, for example, a very dear friend of mine, I would categorize him, and I mean this playfully, I love him, he's a doom and gloomer. He does not trust the financial system. At every turn, every headline, and this has gone on for a number of years now, he thinks this is it, this is the big one, and he wants to own physical gold because if there is a crisis, an emergency, some breakdown in order or in the economic financial system of the country, let alone the world, that owning gold would be a good idea. I don't think we need to comment too much on that thought process, although feel free to do so. My question, though, is if we assume that did happen, I'm not convinced that owning gold would be particularly helpful in that outcome anyway. I don't know if owning gold bars in my basement safe would necessarily be helpful in that instance. Do you agree with that assessment?
I do, again, it's a delicate subject because investors that buy gold, don't necessarily buy it from the perspective of an investment. They buy it from a perspective of emotion.
Right.
I'm not saying all do, but some do.
No, that's fair.
And when you So I just look at sort of the dynamics of what would happen if the entire global fiat system collapsed and the banks no longer existed, there was no financial medium to do a transaction. So in that context, I would consider that pretty much Armageddon. I mean,
sure.
There would be absolutely mass riots, anarchy, the whole supply chain would basically collapse under that system. So here I am, I've got my gold bars in my basement. First of all, there's no market that I can sell these gold bars at, so I go to my neighbor and I say, look, I need some gasoline or I need some food. I highly doubt my neighbor's going to take a 1 ounce gold bar to give me gasoline. Okay. I mean, he's likely to want something tangible that he can use that he may not have, I don't know, a generator, whatever.
Sure.
In that context, I disagree with the conclusion. The other thing that I have an issue with that mindset is that some of these investors believe that the U.S. government is going to ban gold ownership and make it illegal to own gold, which, in all fairness, has happened in the history of the United States government.
Sure.
But the irony of it is that they buy their. When I ask these individuals, where do you buy your gold, they give me a name of a U.S. dealer.
Yes.
And I say, that makes no sense, because the first place the government is going to go to find out who owns the gold is to the U.S. dealers and get their records, and then they'll know that you bought the gold from them. So if that is your concern, you might want to consider buying your gold outside of the United States, either from a Canadian or a European or even a Far East dealer. But then again, your storage of that gold wouldn't be in your home; it would be outside of your country, which I think is what you would want to have happen. If you think your country is going to implode, you would want some of your assets outside of your country. So that would be something to consider if that's your mindset.
No, that's good, and I appreciate that it is a delicate subject. There are many investors, including those in gold, that have significant worries, and they're acting on that. I'm not trying to diminish it. It just seems like, and I don't know the exact phrase you used on it, is some of their conclusions on how to protect themselves, at least to me, don't seem particularly well thought out enough. But what I wanted to ask you about, and I teed this up earlier, and it's been a great discussion so far, thanks again for joining me, is what's your short-term outlook for gold, and then maybe we could talk a little bit about out further what your outlook is. But in the short term, what are you thinking?
Well, we were... Again, when I do my blogs or my commentaries, my orientation is towards individuals that are traders, not individuals that hold precious metals from the perspective of a allocation into their portfolio as just sort of a balanced portfolio. So, from a trader's perspective, I'm very sensitive to the financial news that comes out on a daily basis, and unfortunately, as a trader, I could be bullish at 9 o'clock and bearish at 9:15.
Yeah.
But we suggested back in September of last year. I mean, I'll just give you a little history. That gold had made a bottom in August, and we suggested aggressively getting into the market. We then suggested again prior to the Fed rate meeting in December that gold should be bought ahead of the meeting. We anticipated that the Fed would raise rates one more time in December, and probably not raise rates in 2019. And we still hold that thought process. In that context, we were very bullish gold until about 4 weeks ago when gold hit 1350-ish. There we suggested to get out of the trade and just watch to see if gold could break up through 1365, which is a critical resistance level, and until it did, to stay out of the market. Now, we watched this market come all the way back down, and we re-entered the market just at the beginning of this week, actually, at 1282. And we were anticipating that the U.S. dollar would start to weaken probably sometime mid to late spring, and that would be the catalyst to move gold prices higher. We still believe that is in the cards. In the short term, however, we need, from a trader's perspective now, we need gold to hold that 1278 level. And as long as it holds 1278, we remain constructive both in the short and medium term.
Okay.
Longer term, again, you have to define what longer term is. But as a trader, I can't go past sort of a 1 week, sort of 72-hour type of scenario,
right.
Because again, I'm in and out of the market. But
Sure.
From a perspective of an investor that has not got a gold weighting in their portfolio, and they don't want to sort of jump in at one price, I mean, there is another way to approach the gold market, and that is dollar cost averaging. So if you want to build up a 10% weighting or a 5% weighting of your portfolio in gold, you figure out what that number is, and maybe once a month you come in and you buy a percentage of that position. So now you're going to have an average. You'll be legging in on an average basis to get up to your to your stated number that you need in your portfolio. So that's another way to treat this.
Okay.
But I have never, again, even since the 70s, and in the 70s we had inflation at 18%, 79, 80. I've never used the format of trying to scare somebody into an investment. You need to understand what you're buying, what the volatility potential is in that investment, and you need to be comfortable with it. And and if you buy it at $12.85 and gold's at $12.65 in a month from now, you shouldn't be angry if your mindset was that I just need this as a piece of my overall portfolio, because
Sure.
if gold does go to $12.65 over the next month, it's likely that the other balance of your portfolio, your equities and your bonds, are probably doing better. The economy is doing better. Everything is in a perfect world where everything is working well. Your real estate is holding value. Your equities are going up. Your bonds are giving you at least some kind of a yield. The last thing you want is gold to go to $1,800 because that's going to indicate that the rest of your portfolio is probably going to get hammered.
Sure. No, that makes perfect sense. Let me ask you this, just looking back, and I understand it's a trader's perspective, but, gold has struggled over the last year. It has a negative return of, 3.6% or something like that as of this recording. And over the last 5 years, it's down also. And I know there's been buying and selling opportunities from a trader's perspective all along the way. But why do you think gold has struggled over the last year and even over the last 5 years?
Okay, well, if you look at the movement of gold from 2008 to 2011, when we were sort of right in the meat of the financial crisis, what the Fed did was, and in fact all central banks in the world did, was they ratcheted their rates from sort of a benchmark of around a 3% yield. They ratcheted it down to zero, and in fact in Europe they went to negative yield. And in that context, the dollar got hammered. And gold, as any general commodity, is usually traded in terms of dollars. And with the dollar weakness, because of that huge QE program that the Fed embarked on in 2008, created a movement in gold, and then you added the fear component to it, and gold took off and went to $1,900. I think gold probably, just on a dollar basis, should have maybe peaked at about $1,400, not $1,900 back in 2011. That last $500 was strictly just absolute fear.
Right.
But since then, since about 2014, the Fed has made it very clear, and they've been very transparent, that they are going to tighten their monetary system. So first of all, they abandoned QE, then they started to reverse on some of their bond transactions, and they've been raising rates. And rates up on a basis over the last 4 years, including the bond transactions, have gone up almost 4% in the United States. And that has created a huge flow of money, both into the equity markets and into the dollar, which has been negative for precious metals. And so you've had sort of a bear market in gold since 2014 from the $1,900 level. Now, from a trader's perspective, there's been ample opportunity to pick up 20%, 30% in these markets. When you look at the low of 2016 at 1,060, gold from there rallied up almost to $1,400. Then it went down to 1,140, rallied up almost to 1,360. Then August of last year, it was at 1,170, and it rallied up to 1,360, almost a 13% increase. So from a trader's perspective, there's been really great opportunities to buy, to make money in this market. And, the other thing, and again, this takes a bit more of an aggressive type of mindset, and also somebody with a higher risk profile. Everybody seems to complain that the banks or the governments are controlling the price of gold and they're forcing it lower. Well, you certainly have the opportunity in the gold market to play the game. I mean, you can go short this market. You know, you can go on the COMEX and you can short gold. Mm-hmm. You don't always need to be long. So if you honestly believe that the market is being manipulated lower, you can participate in that. I just think most people believe that they buy gold and they expect it to just fly all the time, and that's just not what gold does. There are times in our history, 92 to 02, where the gold price moved in a $40 range for 10 years.
Yeah, that's incredible.
There's just times when it's a lousy investment, and then there's times when you really need to be a bit more aggressive with it and be a bit more exposed to it. Right now, I think we're sort of right in neutral territory, and I'm not suggesting gold can't go down from here, but over the next 5-year period, I think a $1,280 gold price is going to look cheap.
So thank you for that. In the time we had left, I just wanted to get your thoughts on the following subject. Is gold has long been considered a hedge against inflation. Do you think that is still valid, or has that, in your mind, changed?
Is gold still a valid investment? Is that what you're asking?
No, valid as a hedge against inflation. So if I have concerns that inflation is going to increase, is gold a good hedge against that inflation fear in today's marketplace?
Yeah, I think, again, having been in this business since 74, you always hear inflation is really good for gold. And it is, but it's not because it's inflation. Generally, when you have high inflation, you have a dollar that is getting hit.
Okay.
The dollar suffers because it just tends to be negative for the dollar. You have less buying power with your dollar, and that in and of itself creates the positive influence on the gold price. And then you correlate it and say, well, it's because of inflation. Well, inflation was one of the reasons the dollar dropped, but there could be other reasons why the dollar drops. And I think just in a general format where there's dollar weakness, that generally tends to be a good catalyst for gold.
So I want to thank you, not just for being on the show, because I am thankful for that, but you just taught me something that had puzzled me, because in that financial crisis time frame, I owned for my clients gold, and the thought during the financial crisis, or at least my thought, and I think it was fairly prevalent at the time, was that with the Fed's activity, with the financial crisis, we would likely see inflation. And so we increased or began allocations in gold, and we did really well with our positions in gold, but we were wrong on our thesis because we didn't get much, if any, inflation. But we did get what you just described, which was the dollar went down, not because of inflation, but because of other factors, and you solved the puzzle for me. So thank you very much.
You're welcome, Chris.
Final question is, it seems to me that gold, and you as a trader know much better than I, you could, I think, make the case, or at least I've made the case, that it in large part it's a proxy for your confidence level in the central banks. You mentioned Draghi early on in this conversation, who's in charge of the central bank in Europe, but it seems to me that if you had a degradation in the confidence level in either the Fed or Europe or other central banks around the world, but especially in the U.S., that might be a driver of the price of gold, where now the consensus seems to be the Fed's on top of things. Maybe they are, maybe they aren't. But is that a good way to look at gold in terms of potential short-term drivers of price up or down?
Yeah, well, you also have the geopolitical issues too. I mean, you don't know, North Korea could raise its ugly head again, and Iran's always sort of sitting off on the sidelines there. You've got the Middle East, which is, in my opinion, still a mess. You have potential. I mean, just look at Deutsche Bank. It's trading at $7. I mean, the financial system in Europe looks at best shaky.
Sure.
So, you have there's a lot of things that can go wrong, and in that context, having an allocation to gold just makes sense.
Beautiful.
And you've got central bank buying of gold, the highest level it's been at since 2004. You've got some of the guys that have got big money, like Soros and people like that have never really liked gold, that have come out over the past, even Jim Cramer. I mean,
that is true. He's completely
come out over the past year, and they're all saying, guys, look, this is starting to feel nervous to us. We would recommend considering some allocation to gold. I mean, I've never heard these guys ever, some of these billionaires come out and suggest putting some of their money in gold. So when you've got big money and smart money, I mean, these guys know what's going on. If they start allocating to gold, I mean, God, guys like us, I mean, we should at least pay attention.
Beautiful. Well, for listeners who'd like to get more information about Peter, his last name is Hug, H-U-G. He contributes daily commentary and market insights for millions of readers. You can go to Kitco, Kitco.com each month to get ongoing commentary from him. That's a nice way for people to follow up with you and get ongoing thoughts, right?
Yes, and I mean, they could... you can email me directly if you have any questions. It's phug@kitco.com. I promise you I will give you a response. I can't promise you it'll be the same day, depending where I am and if I'm flying around, but I will get back to you.
Very good. Again, Peter Hug, thank you so much for your time. It was a great discussion, and hopefully I can have you back on the show in the future. It was really terrific.
Great. Chris, it was a pleasure. I really enjoyed being on your show.
All right, thanks. Have a great day.
Same to you.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.
Simply Financial is part of the Exvadio Podcast Network. You can find Exvadio podcasts at exvadio.com/podcast, the Apple Podcasts app, iTunes Store, iHeartRadio app, Spotify, Stitcher, and wherever you find podcasts. So join us and stay informed and entertained.